Good morning, traders. Today is Sunday, May 15th at 9 in the morning, California time. Going to be a very interesting week. Let's go over the basics with everyone real quick, and then I'm going to show you some new custom indexes and some new features we're adding to my weekly videos, as well as to discuss the very real possibility that this could be very close to the end of a potential downward move in the markets. So everyone recently has been freaking out about the Fed and the contraction in the economy. There's two things I'd like to point out. Number one, we haven't seen a massive contagion event take place. So in 2000 and 2008 and 9, we saw a massive contagion event take place. First, the dot-com bubble burst, which was really the end of a massive speculative phase that contracted the markets. In 2009, we saw the global financial crisis, which originated primarily with U.S. housing and extended very poor credit issues, which really started to contract the markets. Now, we do currently have credit issues overseas in many emerging markets and in China that have already been deflating. Of course, we have another COVID event, which could turn into a contagion event. But recently, we've seen the rotation downward here in the markets really be kind of an ABC correction. So when you take a look at it here, you can see from this peak, we come down to these lows, back up to this high, back down to this low, and you have your ABC downward move into this support level, which really represents close to a 50%, really not a 50%, but about a 38% correction on the SPY. In reality, ladies and gentlemen, we're seeing a deflationary trend. The Fed's raising rates in a market that is starting to move downward off of concerns, end of speculation, and my belief is that we're looking here potentially for a bottom. We don't have a contagion event yet, which could cause the market to go much, much further lower. So understand that this is really, in my opinion, this is a downward trend, a correctionary downward trend that's very likely close to ending right now, and there is no contagion event. Contagion event, for example, some massive collapse in the financial world or in some other part of the world, something. It would have to be something rather large, rather dangerous to the financial world would create some sort of a contagion event. This is more of an end of a speculative phase, likely to pull back, likely to find some support down here near the 380, 370 area, which I believe we have already kind of found support. We could come and retest these levels here, but understand that I think we're very close to the end of a trend. And this is what I want to point out to everyone. Now, recently, I'll show you, I've been highlighting, I'll see if I can find it, a trend that suggests this is a wave 3 or wave 4 correction in a very early upward cycle. So we'll point out that here as we move forward. So now let's go ahead and take a look at some of the new charts that we're going to highlight. First, let's highlight this real estate chart. I pulled this up from realtor.com and manipulated some data a little bit. And what this shows you is that from January, basically 2018 until now, over here on the right side, this is the median price listing. This is the price level in blue. This is the median days on market in gold. And this is the number of units that are seeing price reductions. So you can see here, price reductions started to really increase in middle of 2018. This was when the market started collapsing. You can see this. Price levels had reached a peak here and then meandered downward for a period of time, reaching a peak low level as far as price increases. This is price levels increasing month over month or year over year. And then they started to get down near zero here, kind of flattened out right near COVID. So this was a very strong flat period in the market. We'd seen growth in pricing, and then it flattened out. This was COVID. Obviously, you can see here the number of days on market shot up as people went into panic around COVID. And then we started seeing it start to decline after COVID. People started moving, and they went down to new lows. So this was a very big selling. This is when prices started to really ramp up. We started seeing this huge growth level, 14, 10, 14, 15% growth level. It peaked around February, April of 2021, like the markets, has kind of been coming down. But what's interesting now is we're starting to see this massive increase in price reductions while prices are continuing to move a little bit higher. And the way I interpret this is an early stage seller panic. What's happening here is sellers are attempting to get the best price they can. They're reducing prices to try to become competitive. Number of days on market had spiked lower, as you can see right here, and started to really ramp back up over here. My expectations are that number of days on market will continue to rise, move into the positive side here as buyers become more finicky. This is what I call the race to the bottom. As soon as sellers start to do this, as soon as sellers start to decrease pricing to try to get buyers to become more enticed in the real estate, you're going to see price levels start to decline. You're going to see price level growth start to decline. You're going to see days on market start to move higher. This is really what I'm calling kind of a race to the bottom. Now, where the bottom is going to be in the market for real estate, don't know. My interpretation is that as long as the Fed continues to put pressure on the market to try to stave off inflation and to reduce inflationary tendencies, this reduction process is going to continue. You're going to see more and more sellers reduce prices. You're going to likely see some pretty deep price declines in some area. And if a contagion event were to come in the midst of this, we'll have to see how the market really reacts. We don't have a contagion event yet, but we're starting to see some very interesting moves in the real estate market that we haven't seen in quite a while. We got very high price levels here. We've got, again, look at what happened back over here with moderate price decline. This was no contagion event. Reductions crept up to above 20%. The price levels continued to decline until we had a buying event, which occurred right here. This was the beginning of a buying event after COVID. Everybody was taking advantage of cheap houses still. Now we've gone through this excess phase, and now I see this rally here in price declines as showing that this is sellers panicking, trying to get out at the best price they can, trying to attract buyers at these new interest rates. And if the Fed raises interest rates again, my interpretation is that price levels will decline. Obviously, when price reductions start to increase, what happens to the price level of homes? Average price levels start to decline over time as these reductions continue to stay elevated. So this is a process of lowering the asking price, is becoming very excessive, up near 54%. And now this is going to drive downward pressure on sales, on pricing of homes. And depending on how buyers interpret this, if they start to see decreasing prices and sellers starting to panic with a race to the bottom, a lot of times buyers will wait for the right deal, knowing that the entire dynamic of the market has shifted. Okay, next we are going to look at the new Bradley, what I'm calling the Bradley indexes. Obviously, my name is Brad, so what do you think I'm going to call them, right? Okay, so this is the Consumer Engagement Index. The new Consumer Engagement Index is going to highlight for us when we get into periods of really strong buying. Now, this is the 2008-2009 low, and you can see we had these spikes, and I'm looking at these spikes potentially as horizontal target levels. So you can see that we had this spike here. This is in 2015. This is telling us that we could see some sort of engagement or bottom back down here. We had this spike here, which came down. This was in 2019, 2020. This was COVID, looks like. And you can see we've come all the way back down here. So understand that consumer engagement has been declining since really February 2001. We've started to see consumers pull away from the market. Yes, it was a continued speculative phase. Yes, it had peaked out over here. We had this 2020 peak. This was, again, 1920. This was likely COVID right over here. So this was the end of 2019. This was the 2018 low in early 2018, February. We started to see a rally back out of it. Consumers disengaged here. Consumers re-engaged here. and consumers have completely disengaged back to the 2014-15 low levels back over here. So now what we have to watch out for is deeper consumer disengagement. If we see consumers pull away from the economy, which I believe is likely to happen with higher interest rates, higher gas prices, higher food prices, you're going to see consumers make some hard choices, which is that we're going to likely see some very contracted or deliberate spending changes, which means we could see this continue to migrate down lower into this 0.13, 0.14 area, which is down here near these lows, and that'll put us back into the 2011-12 area, back into this peaky area right over here. And what this would look like, ladies and gentlemen, is a continued degradation of economic concerns, the pulling away or the lessening of inflation as this moves lower. So understand, we're already seeing consumers disengage. Consumers continue to disengage. What ends up happening is they spend their money more wisely. They try to react to pricing pressures, gas, food, what have you. Maybe, going to what I call the peanut butter and bologna mode. But this is going to be a continued inflationary decline. So a disinflation or reversion of inflation back into lower spending. Eventually, it may bottom out down here around 13 or 14 when near this low of this spike. But it could get even lower down into these levels, which would mean that we're going to get into a very moderate slowdown over the next 2 or 3 years. And this is where we could potentially see some sort of a contagion event set up, is back down here near 14 or below 14 with regards to some sort of a default event or a mass foreclosure event or things of this nature, especially after having this excessive peak. Next, we will look at the Bradley Custom Technology Index ratio. This is a new custom index that I've been working with. This is telling us here, you can see we're going back to 2017, early 2017 levels here. You can see we're already below these levels. Okay, so this gives you an example that we've already wiped out as far as equity in the market. We've already wiped out all of 2020, the rally after COVID. Remember, COVID was right in this area, okay, February, March, so right in this area. We've already wiped out all of that rally, all of 2019, all of 2018, and all of 2017. We are now down into the 2015-16 lows like I was showing you, and we are likely to potentially try to move a little lower here, try to base. In other words, this move may not be over. We may see a bit more downward activity, or we may see a bit of a sideways activity to the right side trying to form a base. So, but these indicators help us understand where real valuation is. We've seen a massive disruption in the valuation process of the U.S. stock market, primarily within, this is technology, but understand that this is a technology and innovation bubble. We've been in with ARK and Tesla and Amazon and everything. We've wiped out quite a bit of value right now. We're back into the 2015-16 area. Traders are still calling price levels elevated, and they're warning that this could continue lower. I do agree it could continue lower, but I believe we've already wiped out enough value over this time frame that we are now nearing potentially a bottom in the market. I believe we have one more here. We have the global stock market to U.S. stock market comparison. This is updated through last week, I believe. And what we're showing you here is that the U.S. market has already come down about 38%. The global markets have wiped out almost all of the asset growth that we've seen here down into these lows. I strongly believe that this area here is going to provide some sort of support. So the global markets may start to bottom over the next week or two, while the U.S. market may find some support up in this range. There could be some sort of a contagion event that I'm not seeing yet. It depends on really what happens with global debt and foreclosures and potential consumer debt issues, defaults in that area. But understand that the global markets have already wiped out pretty much all of the values. We're really down into these COVID lows and these late 2018 low levels right over here with regards to the global markets. So we've wiped out data going all the way back down over here to 2014, 15, and 16. These were the lows in 16 and 17, right around the election. We could see the markets actually continue to wipe out and try to get down into these lower levels around 500. But this is a fairly good indication right now that we've already exhausted quite a bit of a downside move, maybe getting ready for some sort of an upward movement or some sort of a bounce here. So now let's take a look at the fangs index. The fangs index here has already moved lower, as I showed you earlier. And we've seen it move down below this threshold. Now understand, this goes all the way back to 15, 16, through the 17, and this is the 2018 collapse when the Fed raised interest rates to 2.5%. And you can see, based on this range, based on current economic and taxation levels, we've seen this kind of a rally. We've seen this standard deviation channel. We are now back below standard deviation channels in this area. Again, very close to this low level here where when we had COVID, we started to find some real support. Carry that forward, this blue level here, we may see a bit of a decline over the next week or two back down to this blue level, or we may see some support really set up in this area, and we may be close to some sort of a bottom in the market, which is what I'm really trying to explain, is that barring any type of contagion event, we could be very, very close to setting up a bottom in the market. We've got very clear support levels down in this area, very clear support levels across this green line, and that's pretty much where we're at right now. So if this level holds and traders start to change direction, looking at this as a real opportunistic bottom, we could see some sort of a rally back out of this. Maybe fairly short-lived, but it could be a 10, 15%, maybe 20% rally out of this, looking for some real strength out of the market. It's going to depend really on what the Fed does as well. I'll talk briefly about that. If the Fed raises interest rates by 0.5%, then expect a little bit more of a reaction to the market. That'll really send houses, in my opinion, housing prices into a bit of a turmoil with a race to the bottom. It'll also send the signal that the Fed is willing to topple the apple cart to try to stop inflation. If the Fed comes out with a 0.25% raise and moves a little more deliberately and slower to try to prevent a hard landing, a real collapse in the markets, then we may see some sort of a shift in how capital is put to work, deflating certain markets. I still believe there's going to be a number of defaults, foreclosures, and other issues related to higher asset prices and houses. We're already seeing huge numbers of inventory come in, and for example, in Oklahoma and Tennessee, I mean, people are literally just trying to dump their houses right now while they realize the Fed is trying to raise interest rates. They're trying to get the best price they can, get out of it any way they can, capitalize on this market, and probably try to buy in a year or two later. You know, who knows? Maybe they'll run around in mobile homes or RVs and try to figure out what to do in a year or two from now with all the capital that they've got. But you're starting to see a seller panic take place in higher priced assets. Everybody wants to get out. Okay, the U.S. stock market index, this is a very good chart here. We've seen this this bounce off this 382 level. This 50% level, this purple level still is in play. Ladies and gentlemen, understand that my read on this is that we're fairly close to a bottom, but we could see this continue to migrate a bit lower here. I'm not saying that we should start to buy into anything yet. My longer-term strategies are still bullish. My shorter-term strategies are still bearish. So this is giving us no real clear indication. I'm saying that this 382 level and this 0.50 level could become stronger support overall. We've seen this deeper selling take place. We've seen this real kind of a panic selling take place, but we've come down to levels that, using my custom indexes, show that we're really back down into these valuation levels. And I wouldn't be surprised to see this U.S. stock market index come down below this middle level here around 1,000, possibly in this 975, 980 level before finding support, which would put us all the way back to this level. Understand that if we look here where the green line is and try to go straight across, that'll actually put us just above these highs of 2018, which is a pretty good area, right around this green line. So anywhere below this 0.50 level to this 618 level would be considered very deep selling. Okay, next, the Smart Cash Index. Smart Cash Index has already collapsed more than 50% from these COVID lows. You can see I've drawn a number of different arcing levels, and we're in the midst of a broad arc downward, this arc right here. We're likely to try to find some support. I highlighted this as a potential double bottom a couple weeks ago. It's broken below it, but closed back above it, just barely. I do like this as a double bottoming formation. We're below these lows here, which indicate bearish trending. We're in the midst of a gap here where we filled the gap. This is a similar gap here. We're back down near these lows here, which were the lows in 2018 and the low in 2019. I like this level for support. Now, obviously barring some broader contagion event, I do like this level for support. I really, really believe that this could be a very strong support level. It's getting close to this level, into this support level, this double bottoming formation. And I really believe that the markets have kind of overextended this sell-off based on the Fed. I think underlying, we're seeing a very deep selling pressure that a lot of people don't yet understand is taking place. So again, this is the global market Smart Cash Index, which shows you that we've already come down about 60% roughly from these levels. So this would be a very deep low, a very solid Fibonacci level that looks like this may provide some level of support and maybe attempt to mount a new upside move. An upside move here could potentially be 50% of this move, which would mean about a 35 or 40 point rally here up into these levels, which could be a pretty good short-term move. So be prepared. We might be looking at trying to jump back into some equities. The metals index, oh boy, metals. Everybody's talking about what metals are doing. Everybody's worried about metals pulling through this decline. And I'm going to tell you that metals oftentimes sell off into deeper decline. So here we had the COVID decline. Here we had the 2018 decline where everything started to sell off. And now let's take a look over here. And you can see here, here's the 2018 decline. This was the year that the Fed raised interest rates, and we had the early February decline. You can see metals decline quite a bit. Metals typically decline into downward trending markets and then react strongly to the upside. Now, this took some time here. 2019, metals started to climb. 2019 again, they started to climb. You can see here we had a little bit of decline 2019. Here's COVID, really sharp sell-off, climb back up higher. This was a move from 320 to 480, almost 500. This was about a 45% rally. You can see we've been in a sideways move. We've got this big move. Remember, from 2021 here to here is the huge market decline. Let's take a look here. From 2021 here, fangs index, let me go to the Smart Cash Index. From February 2021 to the low back over here, we've seen this massive deflationary cycle, whereas in metals, we've seen this from the February here to here, we're actually up. So I want you to pay attention that this low, this 413 level roughly in metals, my custom metals index, looks very solid. We could see a bit of a rotation downward if the selling pressure continues, but this looks like a very strong buy opportunity, ladies and gentlemen. I don't see metals really continuing much lower than this. Silver is currently trading at 21.15, it looks like. Let me see if I can get it over here. I got to move the charts. We'll get into that later. But it's a very low $21 level. It was below 21 earlier. Gold is at 1810. These are very solid levels right now in gold and silver for the long-term upward cycle. And you can see from this expanding wedge formation, what we're really looking at here is below this level here, we're looking here at really some great buy opportunities. I think this is going to bottom. I think it's going to bottom fairly quickly. It's going to see a nice 20 to 25% rally. And I think we're going to be back up near the 2000 level in gold fairly quickly. Okay, the valuations index has stalled out last week. You can see a little white bar here. We're back down into the normal range. So now I would say that we're still in the upper level of the normal range, but we're in the normal range area. I wouldn't be surprised to see valuations move a little bit higher, back up above, possibly in this area on a relief rally, and then potentially slide back down into these lower levels. Valuations here is really showing us that we've exited this massive speculative phase. You can see here in 2019, we started to get a little overheated. We had the COVID spike, and then we saw the rally back up to this peak, which was the COVID peak in June, July of 2020. Then we saw the devaluation take place, a little bit of a follow-through rally in 2021, which showed that traders were piling back in to try to ride this next phase. Now we're ending up in a scenario where we've seen this completely erode back down to these lower levels, and we're back down into normal ranges. We could, ladies and gentlemen, slide all the way back down into this 43, 44, 45 level, which would be lower level valuations, very low level valuations, and that could happen over the next 12 or 24 months. We'll just have to see what happens. Overall, though, I'm expecting a bit of a bounce, and I'm expecting that to last maybe a couple months, and then we might slide back into deflationary trending, which is really where the Fed wants us to be. It wants to, think of it as the Fed's trying to take the train from 120 down to 25, very slow around the curves, slow everything down, and then let it build back up the next wave of momentum. Okay, the commodity to gold index, commodities have really deflated. You can see the smaller bars taking place over here. We're back down here near these lows, trying to hold up over here. I think the next big move here in this commodity to gold index, which is a general measure of commodity prices to the S&P and others, is that we're going to see this mitigate these inflationary trends moving downward, just slowly moving downward, kind of a nibble away, not like this was COVID, but just basically roll into these lower levels very slowly, week after week, very tight, nothing major unless we get a contagion event or some sort of a massive COVID event. I think we're just going to see this slowly start to deteriorate downward, and it's going to eventually try to find some support through the end of the year, which means that inflationary trends are weakening. We're going to be able to see that with housing and other trends, but basically inflationary trends are going to start to weaken. As consumers pull away from making big expenditures, house flippers pull away as prices start to decline, you're going to start to see everything's going to go into, let's call it slow motion mode. We're not going to have hyperinflation. We're not going to have the speculative trends. Things are really going to start to unwind probably over the next 6 to 8 months. And by the end of the year, we may see some real basing set up in the markets. Now, this means that fear is going to start to elevate, which is good for gold and silver. We could see a pretty good move in metals. And, of course, the volatility index. Volatility index is holding up. This is one of my favorite indexes. As many of you know, I've drawn these lines last week trying to highlight how we've seen these support channels build. This was the COVID low. This was the 2018 low, and you can see we built this support channel till it was broken. We built this support channel till it was broken. Now we're back down near these lower levels. This 6 level has typically, been a pretty good level for extreme selling. See, when we get below it here, it gets pretty solid. We get some sort of a rebound. We get below it strongly. We get some sort of a rebound. We get a massive COVID event. We get below it very strongly. We start to see it build back up and start to build support, and then we start to get a rebound. We haven't gotten below the 6 level yet. It could happen. We could get a week or two of fairly strong selling or some sort of an event. Maybe, who knows? Maybe some big technology company like Zillow or whatever starts to report some pretty ugly earnings, and we start to see something break down. It'll be short-lived, in my opinion, like COVID was here. You see a big breakdown, 3, 4, 5 weeks, and then it starts to climb back up. This is almost like a measurement of disruption events. We don't have a disruption event yet. We have support. And what's happened is we're seeing devaluation and support down in this area. We're setting up what could be a nice solid support level with these white bars, and we could be setting up for another move back up to 10, 11, 12. We'll have to see how this plays out. If we get a disruption, we could see it move down lower, down into 4s or 3s, or possibly 4.5 or 5. Somewhere down in this area would be a disruption event. That would likely produce some deeper selling, and we're gonna wait. We're gonna wait and kind of see what happens here. We haven't changed anything with the allocation levels, but this does start to look like some sort of a bottom is setting up in the markets. And of course, that's the wrong one. So now let me come to the TT scanner, and I'm going to show you here that we're fairly mixed. We've got a range of buy and sell signals. We've got one new sell signal here in biotech, which is a new sell signal. We've got a couple of sell signals last week in the Dow Jones Internet. We've got a sell signal here in consumer communications select services. Got a sell signal here in technology, IGM. We have a sell signal here in consumer discretionary, IYC. We have a 2-week-old sell signal here in technology, software sector. We have a 1-week-old sell signal here in the NASDAQ technology, NASDAQ 100 technology index. And we have a 2-week-old sell signal here in the XT, the exponential technologies ETF. So what's this is telling you, ladies and gentlemen, is that consumer discretionary, biotech, internet, technology, all types of innovation is really in a downtrend. These are new sell signals. This one here has been in a sell signal for 13 weeks, and this is the biotech signal. It's already hit its first target. We have one up here that's 1 week old, which is real estate. And I believe this could turn into a very solid signal here. We're already 2.8% in profits. We haven't hit any targets yet. We've got moderate downside thrusting. Long and short of it, real estate could continue to migrate downward for quite some time. But this is telling you that the high-flying sectors that were, 6, 7 months ago, top of the list, really the best of the best as far as trying to get in and riding some sort of an upward trend, have now all started flipping into the short side. These are the sectors that are moving downward, and you can see what is moving higher here is gas and exploration, energy, natural resources, utilities, energy, and healthcare. Those are the only long triggers we have on the TT scanner hot list. You can see they've all been around for a while. The newest one over here is the utilities index. It's already hit our first target. We're 1.14% in profits. These here, 20.86 in gas and exploration, 17.63 in global energy, IXC, just under 1% here in natural resources, been 13 weeks in. It's rallied up quite a bit and hit both targets, you can see. This has been 17 weeks. We got 31% profit, hit both targets already. And this has been 74 weeks in healthcare. We've got 14% profit, and we've hit both targets. So you can see we're doing quite well with our TT scanner weekly. It's just the dynamics of the market, the sector rotation has changed. Technology's moving lower, real estate's moving lower. Nothing else is really trending. You can see here that all of these that say flat, 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 these are all basically saying, hey, it's not really going anywhere. We don't want to take advantage of anything. This REIT, this USRT, was moving higher last week, flat, bearish warning. If we get into a broader selling structure, then you're going to start to see a whole bunch of new short triggers coming up. Right now, we just don't have it. We're mixed, which is why some things are still holding up. It depends on how energy, crude oil, and natural resources, metals, and other natural resources, core elements, let's call them, play out. But we're starting to see weakness across real estate, internet, technology, biotech, and consumer discretionary right here tells us that consumers are pulling away from the market. So understand that we're looking at this as potentially moving downward. Consumers are pulling away. Now, let's come over here to our trade tank market gauges and 401k. I believe the markets have kind of flushed out last week on a wave of panic selling. This is a type of capitulation I expect near a market bottom. It may be too early to attempt to buy into these trends, but I suspect the markets have already flushed out an extensive amount of risks. And this is honest to God, I believe the markets have already flushed out quite a bit of risk, and people just don't understand how much has been flushed out of the global economy. I've seen numbers in excess of $7.5 trillion have been flushed out of the market. Now, I believe that the flushing, the process of eliminating risks, is still going to continue for many more weeks as consumers pull back, as gas prices continue to stay high, as real estate tries to find some sort of a bottom. Remember, the increase in lower prices, decreasing house prices, is really excessive. Home sellers are really panicking, trying to get out in any way possible, and this is going to potentially create a panic selling mode where just get me out, I'll take anything because I've got, maybe 100, 150% from my investment. If you bought a house 2008, 9, 10, 11, and you're sitting in huge amounts of equity in your house right now, getting out, taking the cash, sitting on it for a year looks really good. So there's a lot of people who could get out at almost any price and still have a profit. So understand, we're staying exactly where we're at. We're leaving our metals position. We're leaving our bonds position. Bonds started to tick up a little bit. We'll see how that plays out. 65% cash, 10% into stocks. So understand that the way this works, by having these allocations broken out like this, if we did see a 20% decrease in stocks over the last couple of weeks, by only having 10% of our equity in cash, that represents a 2% drawdown in your portfolio. By having a 65% cash, the dollar index has moved up more than 11%. So this means that you've grown your capital by almost 6% by having your portfolio setting 65% cash. Metals have been rolling higher over the past 2 or 3 years. So in reality, if you look at what metals have done as a hedge by having a 25% position in metals, we're actually gaining probably 5.5% in metals over the last year or two. And by having a small allocation in bonds, even though bonds have collapsed downward, this only represents hypothetically a 1.5 or 2% loss in your total portfolio. So let's review again. By having the allocations the way we're at, we've got about a minus 2% here, minus 2% here, let's call it. That's minus 4%. You've got a plus 6.5% here, and probably a plus 4% or 5% here. So you've got minus 4 plus 11. You're still at plus 6% overall, 6 or 7% allocation. Now, in this allocation level, which is an alternate for people who can get into metals or move into sectors like this, we've got an 85% cash, 10% stock, 5% bonds. So again, this would represent about a 1% loss. This would represent about a 2% loss, and this would represent about a 7% gain. So you've got essentially a 4.5% gain roughly in this portfolio over the last 12 months by simply holding these positions like this. And when the markets change direction, we will reallocate effectively to move into a protected hedge position. What that would mean is we would reduce our cash position, move back into stocks, maybe a little bit more into metals, and a little bit more into bonds when things start to actually move. But right now, we're staying in this mode to protect our capital. The purpose behind this is that we still have some exposure to certain stocks. We still have exposure here. Now, this is for ETF and retired 401k type clients. You still have some exposure, but not a lot. You still have quite a bit of capital gains, or actually not capital gains, but currency valuation gains in the U.S. dollar. Metals, if you're able to afford into metals and miners, you still have a moderate amount of gains, and this is really a hedge position. If metals start to take off, it could be really positive. And then, of course, in bonds, we're waiting for bonds to start to bottom and really kind of move this into a stronger position into bonds. So overall, what I want to point out is this is a moderate flush out. We're doing quite well. Our hedging positions have actually netted a gain over the last year, year and a half, whereas most everyone else is looking at really ugly portfolio positions. Oops, wrong direction. And as far as trending, the NASDAQ is long-term bullish, short-term bearish. S&P is long-term bullish, short-term bearish. YM is long-term bullish, short-term bearish. Dow Jones Industrial, long-term bullish, short-term bearish. Transportation, long-term bullish, short-term bearish. SPY, long-term bullish, short-term bearish. Gold, long-term bullish, short-term bearish. Silver, long-term bullish, short-term bearish. Oil, both long and short-term bullish. Nothing has changed from last week. Same trending setup. Now, this has been a bit longer because I've added the new charts, but now let's come back over here and, oh boy, I got a lot of lines on this. Let's see if I can clean some of this up. I'll get rid of that. And let's leave some of these. Let's get rid of this. And again, ladies and gentlemen, we are looking at this setup on the NASDAQ. We're down here near these support channels. I drew this a couple weeks ago. This is a lot. I do a lot of drawing, obviously, and this helps me understand what's going on in the market. So you can see we've got this downward channel here. We've stayed below this downward channel. We're finding support down in this area. This is a fairly deep low. It goes all the way back to this middle level here. As far as the 2020, this was 2020 September. I believe this support level is going to hold. We'll see if we get a nice little rally back up into this area. And we'll see if we get some sort of a relief rally from these lows. Now, obviously, we could see it come back down here into this lower cyan level, which is where my lowest support level is. Puts us down around this red line on extreme downward trending. Remember, we've already deflated quite a bit. So at this point, we're pretty much in the later stages of a deflationary revaluation cycle in the markets. I'm calling it close to a bottom. We don't yet have confirmation of a bottom, but we're getting close to a bottom here, and we're back into this sideways ranging right over here, which was around the election time frame. So could be that we end up back down near these lows. Could be we find some support back over here. We just got to wait until the systems tell us what's going on. Now, I had tried to show you, I believe it was this chart. Nope, it was the NQ. Should be this chart. So now, this is the chart that I want to highlight to everybody. And what I want to try to highlight with this is the potential that we're in a corrective phase. So this is the 2009 low. This is the 2019 or 15 high where we had this rotation. This is 2015-16, just before the election. Let me spread this out a little bit so you can see it. So there's where we had the election, the Hillary Clinton-Trump election. A bit of sideways movement. Then we had the rally after Trump's win. We saw the 2018-19 correction right here, which, if you really want to count it, is an A, B, C, D, back up to E phase, a nice 5-wave cycle up to this cycle, which I will count as wave 3, coming down here to wave 4, which has now reached these new lows last week. So let's see if I can readjust this down to this level. And readjust this down to this level. And my assumption, again, ladies and gentlemen, is if my thinking is correct, this is a wave 1, wave 2, wave 3, wave 4, wave 5. And this is where we're headed, up here. So everyone thinks that we're going to see this massive collapse in the markets, and I'm counting this as, I don't think so. I think this might be just wave 1 right here. This is a big 5-wave corrective wave 1. 1, 2, 3, 4, 5 completes wave 1. Then we may start to see some sort of a downward cycle from here that may be down to here, up to here, possibly down to here as some sort of a corrective wave. And this is what I want to try to point out to everyone, is that what I'm seeing is the Fed has created a huge amount of capital. We've seen an extreme rally phase. We have seen really strong growth, and I believe that we could be looking at, now you could count this as a 1, 2, 3. All right, this might be the peak. What happens here? Well, if this is correct and this is a peak, then we're going to end up seeing some sort of a downward move down into possibly this area, back down into maybe these COVID lows or these 2018 lows, which I've already shown you on my custom indexes, have already kind of taken place with regards to valuation. And then we may see some sort of another upward move to continue higher. Because if this is from a low, a 1, 2, 3 wave cycle, and this is a corrective wave, then ideally the corrective wave is going to come to somewhere around the current levels or a bit lower, maybe down into these levels, and then potentially start a new upward move to try to reach new highs. Now, this next move here should be somewhat in equal size or equal distance to this rally. So understand that wherever we were here, this is a 328 or a 1,200 point rally, almost 13,000, sorry. So now if we come from hypothetically these levels to here and check the price distance. So there's 17. So it would roughly put us right up here as the next rally phase from this deep low, or from this level where we're at right now, it would put us right up here where I was drawing it, right up here to this level. This would be an equidistance rally from this low in 2016 to this high. If this is the bottom and we get an equal distance rally back up here, possibly higher, to try to form another wave, then we're going to be up in this 26, 27,000 range on the NASDAQ. And this is what I really want to highlight to everyone, is that we're looking at the potential of this being a moderate wave. Let's call this wave E, A, B, C, D, sorry, D correction, or a wave 4 correction, prompting a massive wave 5 back up to here that nobody's really prepared for. And this is where I really think that we're going to potentially see a top. Now, this would then prompt a massive corrective phase. So now let me do it this way. This would prompt a massive correction wave if my analysis is correct. And where we would be looking for, these are monthly charts. And let's try to get rid of some of these so we can really see what's happening. If we were to see this as a wave 5 rally, this starting wave 5 of a big wave 1, then this becomes a wave 2 correction, possibly not this deep. Remember, wave 5 up to wave 1 could go deeper. Ideally, this would become our initial support level, but a 50% level of this entire move, which would put it right around here, would be a moderate support. So hypothetically, from here to here, with a Fibonacci retracement, if we were to see it go to here. So we'd be looking at 382 level right here, this red line, 50, and then 618. So in reality, something around here. the 50% level or the 618 level would likely be some sort of a bottom. And then we would likely start to see another rally phase. So now this would represent a total collapse of 56%, 57% hypothetically, and that would be a 15,000 point drop in the NASDAQ. And this is where, like I said, I think we're really headed. I think everybody's missing this next phase and this setup. This aligns with my cycles setup. We are looking at basically 2027 and 28 as being a massive cycle range. So now if I were to draw that, that's way out here, 2027, 28. So let me come back out here and 27, 28. So there's September 2027 right here. And this is where I kind of think we're looking at a major cycle disruption. Now, it could be a little earlier, and this means that this trend here could actually continue out to like this, and then we may get some sort of a setup like this. And this tells us, again, ladies and gentlemen, now it could be a little earlier, but understand that this tells us that we could be looking at a fairly lengthy 4 or so year rally in the markets. Now, gold will likely rally as well as fear starts to build. And this is what happens here as the markets go up. We saw this in 2004 and 2005. I don't think I have data going back that far. Oh, I do. Well, let me see if I can spread this a little bit. Get rid of that. Get rid of that. Auto scale. So now, remember, in 2004 and 2005, right back here, this was the start of a big rally in gold. And we had a fairly big rally in the markets. When you consider what happened from these lows up to these highs, which is the top of the 2008-2009 market collapse, we had 143, 144% rally in the market. Then we saw a 54%, 55%, actually a little more, decline in 2008-2009. Here's the lows 2008-2009, which is where we're looking at this next major move. And I want you to understand that this is from a bottom to a top, 140%, then a 54, 55% decline. If we were to come back over here and really take a look at what I've drawn, you're talking about a massive 140 or 114% rally here, possibly more, then potentially seeing, as I showed you, a 55% decline in this mode, which is very similar to what happened in 2008, 2009. We had a rally of 140%, that followed by a 55, 56% decline. And in this case, we're seeing potentially a rally from these lows of maybe 115, 120% or more, followed by a potential 55% decline. It's the exact same setup as 2009, just broader ranges. Okay, so now what I'm going to do is I'm going to leave you guys with this, and I'm going to just basically show you that I believe we're very, very close to a bottom. We may see a bit of a move down here to about 11,000 on the NASDAQ, which would be a continued washout. We're going to just wait with our current allocations the way they are, wait for the markets to show us where the opportunity really lies. Ultimately, though, ladies and gentlemen, this is what I'm seeing as a real rally. Now, it could be, obviously, that it doesn't go till 2027. It could peak out in 2025, 2024, potentially doing something like this, moving into more of a crisis phase kind of around here. Oop, I'll fix that. Moving into kind of a crisis phase right around here. And this could be something that sets up. But I think we're going to come out of this, and with the Fed creation of capital, and with some sort of another bubble phase, maybe technology, maybe disruption, maybe innovation, maybe space, Who knows? Maybe marijuana, maybe psilocybin. Who knows what's going to be next? But the next rally phase could be very, very explosive, and no one's seeing this right now. No one really understands that these are the broader cycle phases, and my cycle analysis says that sometime between 2025, 2026, and 2028, 2029, we're going to end up in a massive blow-off peaking phase, which is going to prompt a big rally in metals. So this is going to move metals extensively to the upside, bigger than anyone ever imagined, as we get closer to this big unraveling phase. And this will freak people out. It's a same 55% downside move, but this will freak out a lot of people to be able to watch this collapse and eliminate potentially 6-7 years worth of advances. And this could continue for many, many years afterwards, but we're not there yet. What we need to be concerned with is the next 2 to 5 years, getting to this point, and then prepare for this big move, which is setting up next. All right, that's it for now. Remember, follow my YouTube channel, follow my Twitter. Please help me. What I'm trying to do is give you this research so that you can stay aware and away from risks and understand what I'm seeing in the markets. Now, remember, this is all done under the disclaimer of education. I'm not trying to tell you what to do. I'm trying to help you make better decisions so that you can use my research and my understanding to be better protect your assets and grow your assets, staying away from risk. All right, so go to my website, ment.com, learn about what I do for you and how I try to help you, and I appreciate your time today. A bit of a long video, 1 hour, but well worth it. I hope you enjoy. Talk to you later.